What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at gold and the fact that gold looks like it is about ready to explode, hit that all-time high number in US dollars finally, for a mix of both technical and fundamental reasons. I just love it when we have the perfect storm of technicals and fundamentals meeting each other and both saying the same thing. Let's dive in. All right, so just for an easy visual, I've got a chart behind me of GLD. This is an ETF that invests in gold bars, basically, and so it pretty closely tracks the percentage movement of gold. You can see in 2011, after the fears had subsided from the financial crisis, we had gold peak at around $1,900 per ounce. Gold sold off a lot and then for years traded in the range between roughly $1,200 an ounce and $1,350 an ounce. That was kind of the range that it stayed between. It bumped out a couple of times, but in general stayed in that range right during this time frame. Now, since June of last year, we've been experiencing a fantastic bull market in gold, largely due to the quantitative easing, the monetary policy that the Federal Reserve has been engaging in, lowering rates, buying treasuries, just the downward pressure on the dollar, really, not necessarily compared to other currencies, but compared to things with, more stable value like gold. Downward pressure on the dollar, that's upward pressure on gold. And so we've had this massive, great rally in gold, just even over the last year, going from that $1,350 per ounce up to today, it's $1,750 an ounce, so about $400 up in the last year. Percentage wise, that's about 29%, so a 29% gain in the last 1 year from today. That's pretty decent. The problem is it's still really not taking into account a lot of the things that gold experts think that the gold price should be pricing in. The future devaluation of the dollar, the continued quantitative easing, the continued reckless monetary and fiscal policy, and just the general risk in markets and especially paper markets around the world. And so that's left some scratching their heads. 30% over last year is good, but it's not anything like what some of the gold experts are saying we should have seen by now or should be seeing soon. Now, in a past video just a couple of weeks ago, I made my predictions about the rest of the year, and I said that over the next 2 to 3 months, I think the gold price will hit $1,900, will hit that all-time high mark, have maybe a little bit of a sell-off then, a little bit of a consolidation before it continues its rally. I think that strong gold rally will continue then for at least the next couple of years. Today, though, I'm slightly changing that. I'm bumping up my time frame here on when I think gold will explode, and I think it's going to start to happen next month in just a couple of weeks here. In July, we're going to start to see a breakout here. Now, from a technical analysis perspective, take a look at this. We've had, for the last year, fantastic momentum behind us. When the coronavirus shock hit, there was a liquidity crisis. There was a liquidity event where people had to sell whatever they could, and gold had maintained its value better than everything else. And so gold got sold off in order to, meet payments. There's, when in a liquidity crisis, you don't sell what you want, you sell what you can. Gold got sold as well. So right in March here, there was a big sell-off. That's called a shakeout, really. It shook out the weak hands, and pretty much everyone who was going to sell at some point due to profit taking or fears or whatever, sold at that point, because all the people who withstood that big drop right there, if they held on during that, they're going to hold on right now and for the future, right? If that didn't shake them out, really nothing's going to shake them out. So only the strong hands stayed in. Since then, we came back up here. We got to this new level right up here in between $1,680 an ounce and $1,750-ish an ounce. That's this channel that gold has been trading in since it popped above this line here. This is called a consolidation period. This is a coiling of energy. After a big rally up, you expect to have a sell-off, and then you expect to see the price kind of stabilize. And this is just consolidation. This is buyers and sellers trying to find, where it belongs. But the momentum overall, especially over the last 5 years, is extremely bullish. It's up. And so we've got a lot of momentum behind a consolidation pattern. That is bullish, especially since it's preceded by a big sell-off right here. which shook out the weak hands. So from a technical perspective, I love this chart, especially today. I'm recording this video Friday, June 19th, and we closed at a good amount. We closed at, I think, 1740 per ounce, 1745 per ounce, somewhere in there, which is at the top of the range. So could happen sooner, but I'm more likely to think that we're going to break out and start that rally again in July, not because of the technicals, but because of the fundamentals that are matching up with it. Okay, so the fundamentals of gold are largely driven by central banks, large players, and the bullion banks, the gold trading desks. These are the players that are playing with the most money in gold markets, and they're the ones largely driving the price. Take a look at this chart. This shows the net contracts open, and futures are the way that gold is traded primarily. Rarely nowadays is gold traded physically. Usually it's futures contracts, and then instead of asking for delivery or delivering the futures contract once it is expired, they are usually closed out ahead of time and just settled in cash for the difference in the amount. Now you can see here that as of recently, futures contracts are at record shorts. And keep in mind, this is net, like naked, like actual shorts. And so if delivery was requested on all the people holding the other side of these contracts long, there is nowhere near enough actual gold to deliver on these. And so trading desks, gold trading desks and bullion banks are desperate right now to close out their net contracts. The problem is when you close out a short contract, you have to buy that contract back to close it. What happens when you buy a contract? Well, that soaks up selling pressure, especially when you start buying up when you have a lot of naked shorts to buy up, that's buying pressure to close those out. Buying pressure drives prices up. So take a look at the last time that these net contracts were this short and then they had to close them out and they got back to a more manageable net short amount, and that, the buying pressure, they closed out all those shorts. Look at what it did to the gold price. This was early 2016, and it made the gold price just absolutely explode. Now, gold trading desks, bullion banks, they were able to resume their game because they kept gold locked in this channel underneath $13.50 an ounce. And so they resumed their game of flooding the market with net shorts, which is selling pressure, which drives the price of gold down. But here's the real problem with manipulation. Whenever, it's not really a conspiracy theory or schemes. This is just the way trading desks operate to try and move prices to make a profit. Manipulation, though, long-term never works because you ultimately get yourself into a situation that is not backed up by reality. In this case, a net short naked position that's not backed up by physical gold, which means when all of that starts to get closed out, you experience a massive rally and it backfires on anybody who is the last one to escape. And ultimately, this has really started to happen recently, and that's why we've seen gold trading desks start to close down. HSBC's gold trading desk, in one day, they lost $200 million, which is the amount that they usually make every year from their gold trading desk. Massive losses from HSBC's gold trading desk. We saw Scotia's shutting down their gold trading desk. And I think there was another one, ABN or something like that. They're shutting down their bullion trading. And so across the board, it's putting gold trading desks out of business, and banks are not now allocating more money to the gold traders, to the bullion banks, because they're not able to keep the price of gold down anymore, because every time they try to alleviate some of this net short contract, some of these positions that they're in, it just pushes up the price more and more and more, and it makes the losses even larger. Now, with the contracts expiring at the end of this month, that's why I think this will start to pop again to this next phase of the rally in July, because this month we've got another set of contracts expiring. And so everybody who had, all the big players who have net positions right now, have it in their interest to keep the price as low as they can during this time. And then they'll, try and, restart the next phase over, restart getting out of their net short positions for the next contracts. They'll close out what they can and roll over what they can't. And so ultimately, since this, gold rally really started over the last year and gold trading desks have been caught with their pants down, these naked contracts, and they've been trying to close it out, all it's done is contribute to massive pressure upwards, really to get gold back up to its fair value price. Because if there were no naked contracts being traded, and only contracts could be traded that were actually backed up fully, that would push the price up a lot more. Because right now, like, that would be just closing out all of those net contracts that would push the price up higher. And so the fair value, just from that standpoint alone, is a lot higher than it's at right now. So over the next month and a half, sometime during July, I think it's very likely we see gold explode out of this trading range and head up to that $1,900 range before they're able to load up on some more shorts again to push it back down. When it hits that natural resistance point at its all-time high of 1,900, there's going to be a little bit of sell-off, so they can use that to try and get out of a little bit more of the position that they're in at that point. So that's my outlook over the next 6 weeks to 2 months for gold. I think, we're definitely not going to go below this trading range here, because every time we get to the bottom of it, they use that opportunity to close out more of their shorts, which pushes the price higher. So I think we're going to stay in this trading range at least for the next week to 2 weeks, and then after the contracts expire, going into July, we're going to see the rally start to resume up into that $1,900 mark. So that's my outlook for gold. It really looks like we're about to see a nice pop soon here. So that's my outlook. It's not advice. Please don't make any trading decisions off of what I say here. I'm not a registered investment advisor. This is just education on how the markets work. So hopefully it helps you out. Make your own decisions. And if you like the video, learn something, like, share, subscribe, help the channel out. Really appreciate it. You guys have a great day.